All right. Welcome. Weekly Roundup, Heart Investment Group. I'm Scott. That's Ben.
Hello.
Let's get into it. Rocky Friday. Let me just read
Wow.
let me just read off a headline here because I know
Okay.
it's what has all your attention today. Silicon Valley Bank is shut down by regulators and the biggest bank failure since the global financial crisis. And go.
Wow. Wow. Is
Yeah.
really all I can say about it. Holy cow. There's tons that has come out today, lots of activity. Certainly some people have been following some of the other smaller ones, but this one was pretty material. On top of it is 93% of all deposits at SVB were above the creditor protection limit. So all those deposits are, so 7% of the deposits is what people are going to get back.
Wow.
Yeah.
That's devastating
Yeah.
for some people.
It's big. It
Yeah.
is. It's going to be material.
Did they say how much money what was lost, like cumulatively, or?
So I think so. I looked at the market cap earlier today, and I think it was showing around 6.2 billion market cap as of the close last night. The stock never opened today, so I'm thinking if we look at how it's cascaded over the last couple of days, you're probably looking at something in the neighborhood of 15 to 20 billion market cap on Wednesday. Obviously 2-0 today.
Wow, that's
Yeah.
crazy.
Yeah.
So if you came to the weekly roundup for your good news, today's might not be your day.
Probably not.
Probably not.
From a big picture perspective, from an asset allocation perspective, it was a fantastic day because bonds rallied hard.
Yeah,
Best day for bond markets in years. So
yeah.
yeah.
I thought your blog post today was interesting, or the daily. So, and just before getting to that, if people haven't seen it or aren't receiving the daily email, we've changed it kind of into a blog. So we'd love your feedback on that too. If we've already got some back that they like it better because we can go into a little more detail, and we have a new blog post every week. Or sorry, every day. We've been writing new blog posts on different
Yep.
things. But today's blog post, you were talking about the U.S. What was it again? The
The
U.S.
financial system.
Yeah, the U.S. financial system. Yeah,
Hmm.
and you're not too you don't have a real optimistic outlook on that either.
Yeah, so I think it's been, as what I'm always fascinated by is every time we get into this, I've been doing it for 23 years now, but every time some kind of event happens, things have changed. And so coming out of 2008, the financial system changed quite a bit. How the banks are forced to, keep certain reserves, not trade bonds, no inventory, like the system changed dramatically. The rules continue to change and fine tune, and so, like the only capital that U.S. banks were allowed to keep after the financial crisis have been treasuries, basically, or AAA type of credit, so to speak. And so, as they keep 10 to 15% in reserves, that money ends up going into treasuries that they give to the central bank, but the banks never actually have to mark that on their balance sheet. So you don't actually see the losses or the gains. And so, we've had interesting event over the past 6 months where we've had quantitative tightening, which has squeezed kind of the financial system. We've had short rates where the central bank controls in the US, moved short-term rates up to 5%. So you get the bank's kind of balance sheet deteriorating as rates start going against them. And then you get savers saying, well, I can take money out of my bank account earning 0 and buy a treasury bond owning 5. So their balance sheets are getting deteriorated and there's money flowing out of the banks. That's terrible for them. And so as we see this kind of activity in SVB and others, it gives you some concern. Additionally, we saw earlier this week that Credit Suisse hit their kind of historic all-time low. Credit Suisse is a systemic bank. It's connected to all of the other major banks of the world. So, what looked like nothing a week ago is starting to look like something that we need to pay attention to. So, as I say, from a portfolio perspective, um, super underweight banks, maybe have a tiny position, mostly in Canadian banks, but no U.S. banks, and good exposure to bonds. And the 2-year bond in Canada, or sorry, in the U.S. had its best single day in the last 5 years today. And if you look out the curve, like longer duration where I have exposure, like TLTs and EDV, TLT was up 5% today. EDV was up closer to 7 or 8%. And so portfolio wise, listen, positioned well for something like this. But from a overall, risks within the financial system, they've risen dramatically in the last 5 days.
Yeah. Okay. Is there anything else you wanted to cover before we get to the charts?
I don't think so.
Okay.
Yep.
It'd be a good time too. If anybody has any questions, you know what to do. Just put them in the Q&A button in the bottom bar there. Okay. Well, let's see what we have for how many charts we have today, Ben?
A few.
Oh, that's never good. When you don't give me an exact number, that means more than 5. Okay.
I think you're gonna love my first chart though.
Okay. All right.
Are you so do you
What's that?
so are you on LinkedIn? If you're on LinkedIn, for anybody on LinkedIn, I don't know, I get these all the time where they're like, this job fits your profile. And this came to me today. This is Managing Director, Advisor Growth and Enablement for Silicon Valley Bank.
Oh my goodness. That's hilarious. Are you gonna apply?
The building's burning. Run towards it.
It's on site too. I'm not sure I'd want to show up there tomorrow.
I'll hit a couple on this and then talk a little bit more about kind of the banking system a bit. But this is JP Morgan's research on Silicon Valley Bank in December. So we are just less than 3 months away from when this happened. So they had a $375 target on the stock. And so it's interesting, just, we sometimes we rely on these big research houses for information. I think it's always important reminder to question and think about it and think about what what the potential risks are. And just because a big bank puts out a buy signal on it doesn't necessarily mean it's something you want to do. But this was a deep dive with the CFO less than a quarter ago, and you read the front page and essentially tells you like there's a material risk happening, yet they go overweight with the higher target price. So I thought always try to pay attention to these things that are coming. More from a market perspective. So this is Jim Bianco, always puts out great charts, and this is talking about 2s, 10s. And so we went through a full percent where the 2-year is higher than the 10-year. And obviously today we saw both. We saw 2s and 10s kind of yields fall as prices went up today. And so you may have caught in the daily, I think it was on Monday or Tuesday this week, where I said, you know what, signals that you're in with signals you're coming towards a recession is this inversion. What signals that you're in a recession is flattening, and what signals as you start to come out of it is steepening. And so we've reached kind of, I think, close to at least maximum inversion right now, and the next little while is going to show us at what point of the kind of economic slowdown we're at. So this is a great from Jim.
Great.
So just as a point about the kind of some of the risks that are in the system, this is an overview of the US dollar CDS signal. So this is credit default swap. So this shows you some of the risks that are rising in kind of the sovereign market. And so this is US dollars. And so we've seen this rise quite dramatically in the past couple of weeks. So if you look, this is we're at the bottom of this year. We're in, this is December, January, 0 credit default risk up to kind of 41 inside of a quarter. So these are things shouting at you, pay attention. There's things happening within the market that are different than we've seen for the last number of years. So to my point, just about this is from Macro Alf. Again, if you're interested in learning about macro, this guy is one of the best I've seen. He puts out a lot of free content. His paid content is excellent as well. But this is a view at, as I said kind of earlier, the banks don't have to actually liquidate their portfolios. They kind of just carry it as a loss. And so this is a view at how dramatic it's gone over the past quarter. And so again, these are things happening in the system that says to you, kind of pay attention. Something's happening right now. And so this one's a bit of a busy chart, but I think the notes down the right hand side of this are worth watching and paying attention to. Essentially, it says quantitative easing prints reserves. And so that means that gives more reserves into the financial system. Quantitative tightening destroys reserves. So that's where the cycle we're in right now, where the central banks are tightening. They're kind of taking liquidity out of the system. And then it says when the government needs to roll over to funding, that's when they need the private sector to step up. And so that's right now where the treasury market's hoping and relying on the private sector stepping up and buying these. And then the last point says the bank's portfolio forcefully shifts towards more bonds and less reserves. And so that's what's happening right now as as quantitative tightening, more money is moving towards kind of supporting that bonds in that system right now. But essentially, it's an overview of how things ebb and flow depending on whether central banks are doing quantitative easing or quantitative tightening. Again, all of these things are having ripple effects, and we're seeing them in real time right now. And it's saying to us that we need to pay attention.
Good.
Yeah, last one, I promise. And so this is just a look at SHY, which is effectively the US 2-year in an ETF form, SHY. And so this was the move today. So this is over the last kind of 4 or 5 months. So this is the move we saw today out of the bottom. And we saw volumes pick up quite dramatically. And so this is a sense that maybe there's something happening, and if the short-term rates are starting to move dramatically as well, it could be signaling that there's something changing in what the central banks do from this point.
Gotcha.
Yeah.
Wow, it's quite the run.
Yeah.
There. All right, good stuff. Good stuff. Okay, no questions there just yet. Ben, I can tell you've been dialed in all day. You just kind of have that energy about you. You've just been like
Buzzing.
super focused on what's going on in the world. It's good.
Yes.
Okay, well, why don't you give us an update on what do you see coming up this week? Everything will settle down over the weekend, or we're gonna
Well, I think we're gonna see a lot of things come out over the weekend. I think there's a lot of regulators probably going to breathe a sigh of relief when it hit 4 o'clock today, so that we can see what has happened and what's transpired. With, as I mentioned, Credit Suisse, the SEC told them to delay their filings, so I'm sure that's going to probably work itself out over the weekend. So we'll see how that plays out. As for how SVB, if there's ripple effects, I think when something like this happens, unless you know the company intricately, you have to see where the connected ties are to. And so certainly I think this is a fallout from FTX. And so it'll be interesting to see who else is connected in there and see if there's any ripple effects to the bigger banks. At the present time, there doesn't seem to be any that I've seen materially yet, but I'd be paying attention to that over the weekend. All of the regional banks could potentially have exposure to this as well, so I'd be watching for that. And I've had calls and questions today from clients and saying, well, this must be a great opportunity. And typically I'd say yes. But given the scale and the speed and the severity of what happened this week, it's more of me saying, like, let's just take a look, see what happens. We had the conversation earlier this earlier today where we were talking about is it like 2001, is it like 2008, and at least from experience it feels like both of those ones together combined. And so with as a result of those two pieces kind of banging into each other, I'm saying let's just be patient. As I say, the bonds did well today, nice rally, nice lift, portfolios are protected as a result of that, and now let's be patient, just see where things fall right now.
Gotcha.
Yep.
Okay. Any parting words?
I'd say the last one, which we didn't even talk about, which I think I referenced last week, would be a big deal, was Bank of Canada on Wednesday.
Oh yeah.
They did not raise rates and signaled they would not raise rates. First major central bank to go on pause. While it may not seem like anything, I think it is more than you'd think. And so we'd continue to watch as the the Bank of Canada continues to speak and put out information. But I'd say that was a pretty material signal this week, and so it was nice to see them go on hold. But that was a pretty other big news piece that we talked about. Next week we'll watch it and see what happens. But lots of ground, lots of things happened today that is really outside of what we've seen in a long time.
Gotcha. Okay, and just from a housekeeping situation, tax season, a few people, well, we've quite a few requests for gain loss reports. So if you have requested it, you don't have them yet, you will very shortly. We're trying to stay on top of the list here. So you should see something early next week.
Yep.
If not today, I still have a few more to do today. So yeah, so we'll get back to you on that. If you have not yet requested it and you want those documents, or you're not sure where to find your tax slips on your online account, then also let us know that and we can help you get those as well. Okay, that's it for us. Started March break for the kids, so we'll both be busy this weekend.
Sounds good. Absolutely.
All right, have a good
All
weekend,
right,
everybody.
everybody, take care.
Bye now.
Thanks. Bye.